We have to face reality is that we're at the bottom of a secular bull market in bonds, and I think it would be a protracted bottom, but the big gains to be made in bonds, quite frankly, in our lifetime, notably in Treasury bonds, have been made.
PIMCO's Paul McCulley speaking to Bloomberg News this morning, saying treasuries have topped out. For more perspective, we're joined by Daniel Fuss, vice chairman of Loomis Sayles and co-manager of the Loomis Sayles Bond Fund, which is up 25% year to date compared to competitors who are only up an average 11% on the year. Dan, thanks so much for coming live onto our show.
Thank you.
First up, do you agree with Mr. McCulley if treasuries had the run of a lifetime?
Well, they certainly have. I agree with that.
Once in a lifetime run, rather.
Well, I'm not quite so sure. I still have a long life to go.
Let's hope we all do. Why is that?
Well, in first place, it's been a phenomenal run. They had two runs. They had a very good run back in '03, peaked out in about the third week of June of '03, and then started sliding. And then since last fall, they've had another very strong run. Most of it really last fall, but then some more this year. I agree with the general thought that we're in a price-wise, a long bottoming process for treasuries, but I'd emphasize long. The fundamentals looking forward are not good. I mean, the Treasury borrowing requirement is formidable. They're going to issue a whole lot of bonds. That normally tells you something about what to expect in the market. But I do think that the near-term forecasts on the Treasury borrowing requirement, in fact, are too high. And that's just starting to show this week, because this week's auctions, as formidable as they are a little less than the forecast. This humongous amount of money that the government has put out, some of it's starting to come back with interest, so we're bringing down the borrowing requirement. That's the short-term technical.
You and I spoke in June, and back in June, you said you're avoiding treasuries and instead focusing on 10-year range of corporate bonds. Is that still the case?
It is, but very short-term now.
Okay.
I'm a long-term investor, so I'm going to talk short-term. The corporate markets had a phenomenal run. And right now we own a few treasuries, and they happen to be long. It's swimming against the tide because the longer-term picture for treasuries is not good. But the corporate market's, in effect, gotten ahead of itself. And so there is a case to be made short-term for treasuries. And to the degree the treasury short-term brings down its borrowing requirement, that's more the case. Longer-term, for the balance of this cycle, next cycle, next cycle, next cycle, it doesn't look that good under current fiscal policy. Now, if fiscal policy changes, that could be a whole different ball of wax.
But if you look at credit spreads, they were widening earlier last week. They've come in a little bit early to start this week. Is it fair to say, though, that both the high-yield market and the Treasury market like what's coming out of the central banks?
I really don't know.
Okay.
To be honest, both the high yield and the investment grade market, corporate bond market, feel a little pricey right now. You've had a lot of money coming in. Spreads are still wide historically to treasuries. Most of that's because treasury yields have gone up somewhat, and corporate yields have come down a lot. So I wouldn't read too much into what the central banks are saying. What the central banks are saying is well-intentioned. They hope to do these things, but they have to deal with the reality of life. You know,
what is the reality in your view? What do you want this exit strategy that we're all so concerned and wondering about to look like?
Well, I think it's going to be slow. I don't see how it would be. Let's say the three of us happen to be the central bank board, okay? God save us. Here we are. We're the central bank board, and we're looking at this, and we say, now, the economists tell us it's time to gradually start to take a few bank reserves out of the system. How far is that going to go? What's just happened to the economy? Politically, you can't do that. You have to be very, very, very slow. If you could play it by the textbook, it'd be wonderful, but it'd be the end of the central bank. Politically, that wouldn't fly.
Do you still think the 10-year Treasury is going to be at something like 6 1/4 in the next 4 or 5 years?
Yes, I do.
Why is that?
Because they're going to issue an awful lot of treasuries.
Simple as that.
As simple as that, and underlying that,
interest rates got to go up at some point, right?
Well, they do. Now, you say, well, that doesn't have to happen because maybe they won't have to issue all the treasuries because maybe the federal government's revenues will get higher than the federal government's spending. Wouldn't that be wonderful? But I don't think it's going to happen. That would mean a ferocious increase in income taxes.
Mr. Fuss, let me ask you about your bond fund, up 25%. Compare that to an average from your competitors of an 11% gain year to date. Talk about your particular strategy. What's working for you? What do you think you know that perhaps they don't?
Oh, we all know the same stuff. They really do. It is literally, I say this and people laugh, but the case is it's same bonds, new prices. We owned those bonds at the beginning of the year. The prices have gone up a lot. Now,
so then what did they do wrong, your competitors?
They didn't do anything wrong.
But that's a wide margin, 25 versus 11%.
But you should have seen last year. It was the flip side. You know, it does get down to bond picking, but short moves like this, to say you're plus 25 or minus this or relative to that, it's the same bonds and the prices move around. What you want to do over time, and I hope we do a good job of, is pick cheap bonds that will continue to pay you, and that we've done.
Mr. Frost, we have about 30 seconds left. The banks have a lot of reserves. When are they going to start lending money again?
Well, some of them are, but in the aggregate, they're still being very cautious. And probably wait for the economy. You know, they're trying their best to put their balance sheet in better shape. And they're actually shrinking a bit. As they see better opportunities to lend money, I think they will.
Dan Fuss, the Vice Chairman of Loomis Sayles, joining us on set this afternoon. Mr. Fuss, always good to talk to you. Thank you.
My pleasure. Thank you.